What if the biggest financial mistake you make feels completely responsible? Headlines say inflation is cooling, but your rent still climbs, your groceries still cost more, your paycheck feels stuck, you cut subscriptions, you skip vacations, you delay big purchases, yet somehow you feel further behind. Here is the uncomfortable question. Is playing it safe actually costing you $10,000 or more? And if so, where is that money really going? In the next 7 minutes, I will show you exactly what is happening and the pattern that explains everything. In 2022, U.S. inflation peaked at 9.1% year over year, according to the Bureau of Labor Statistics. That was the highest level since 1981. Now think about this. If you kept $10,000 in cash during a year of 9% inflation, its purchasing power effectively fell by about $900 in 1 year. No stock crash, no risky bet, just time. Meanwhile, U.S. personal savings rates dropped from over 30% in April 2020 to below 4% in 2022, according to data from the Federal Reserve Bank of St. Louis. That swing is massive. This directly affects your rent, your groceries, your emergency fund. Because when your money sits still during inflation, your purchasing power quietly erodes. By the time this video ends, you will understand why this number is far more serious than it looks. But here is where it gets really interesting. To understand what is happening today, we need to go back to 1979. Imagine walking through New York City in 1979. Gas lines stretched for blocks. Inflation was above 13% that year, according to the Bureau of Labor Statistics. Paul Volcker became Federal Reserve Chair in August 1979. At that exact moment, something shifted. The Federal Reserve began aggressively raising interest rates. By 1981, the federal funds rate exceeded 19%. Mortgage rates surged above 18% in 1981. Borrowing costs exploded across the country. Families who thought they were playing it safe by keeping money in low-yield accounts saw their purchasing power collapse as prices surged faster than interest earned. According to historical Federal Reserve data, real wages lagged inflation during that period. People felt trapped. They saved more cash for security. But inflation punished idle cash. At the same time, businesses with pricing power adjusted faster. Sound familiar? Because this is strikingly similar to what is happening right now. Wait, this next part changes everything. Here's the mechanism. Think of the economy like a large water tank. Money flows in through wages, loans, and stimulus. Money flows out through spending and debt payments. When central banks lower interest rates, borrowing becomes cheaper. After the 2008 financial crisis, the Federal Reserve cut rates near zero by December 2008. It also began quantitative easing in 2008. Quantitative easing simply means creating digital money to buy bonds. According to Federal Reserve balance sheet data, total assets grew from under $1 trillion in 2007 to over $4 trillion by 2014. After 2020, the balance sheet expanded above $8 trillion. More liquidity entered the system. When money supply grows faster than goods and services, prices tend to rise. This is basic supply and demand. The International Monetary Fund has noted that rapid money supply growth often correlates with later inflationary pressures. Now here's the subtle part. When inflation rises faster than savings yields, cash loses real value. Meanwhile, debts fixed at low interest rates become easier to repay in inflated dollars. So the system quietly shifts. Savers lose purchasing power. Borrowers with fixed rates gain flexibility. This is the part most people never hear about. Because doing nothing with your money is still a financial position. If this kind of analysis is useful to you, subscribe, because next week I am covering how interest rate cycles historically reshape housing markets. Remember that question from the beginning? We are almost at the answer. Remember that question I asked at the very beginning of this video? Is playing it safe actually costing you $10,000 or more? Here's your answer. Historically, during high inflation periods, cash-heavy households experienced significant real losses. In 2022, real average weekly earnings declined when adjusted for inflation, according to Bureau of Labor Statistics data. That means paychecks rose in dollar terms, but bought less in reality. Your savings might look stable on a screen, but your purchasing power may be shrinking. Meanwhile, asset prices often adjust upward during inflationary periods, though not evenly or predictably. While institutions can reposition balance sheets, ordinary households often react slowly. That delay is expensive. A 5% to 9% inflation environment sustained over several years can erode thousands in purchasing power on modest savings. And here is the connection nobody is making. The real $10,000 mistake is not a bad investment decision. It is ignoring the silent math of inflation. But here is what historical data shows people did that helped them navigate similar periods before. They focused on real returns, not nominal numbers. They paid attention to inflation-adjusted outcomes. They understood that economic regimes change. Historically, during similar inflationary periods, real assets often adjusted over time. Looking at the early 1980s recovery, ATION fell sharply after 1982. Real wage growth eventually stabilized as inflation cooled. Research from the National Bureau of Economic Research has shown that inflation shocks tend to redistribute wealth between borrowers and lenders. Every economic situation is unique. This is purely historical pattern analysis. During the 1970s, Treasury yields eventually rose into double digits. That changed savings dynamics completely. Higher interest rate environments later rewarded savers differently than low-rate environments. The key pattern is simple. Economic regimes change. Cash behaves differently in high inflation versus low inflation periods. Debt behaves differently. Wages behave differently. Understanding these patterns is exactly why this kind of analysis matters. Awareness is the first step toward preparedness. We started this video asking whether playing it safe could cost you $10,000. Now you have the historical context to understand what that answer really means. The risk is not action. The risk is ignoring inflation's silent math. Next video, I am covering how interest rate cycles reshape housing affordability and why timing has historically mattered more than most people realize. You will not want to miss it. Subscribe so you do not miss that analysis. This video is for educational and informational purposes only. It does not constitute financial, investment, or legal advice. Always consult a qualified professional before making any financial decisions.